All right, let's dive right in. Today, we're going to tackle the language of law. Specifically, we're cracking open Uganda's Income Tax Act to understand the words that form the very foundation of the tax system.
You know that feeling, right? You open a legal document, and suddenly you're staring at a wall of text that feels like it's written in another language. It can be super dense and honestly pretty intimidating. If you've ever felt that way, trust me, you are not alone.
But here's the thing, it's not some unbreakable secret code. And today, we're going to crack it wide open together. We're going to translate that core legal jargon into plain English so you can actually understand the rules of the game.
So here's our roadmap. First up, we'll talk about decoding the tax code itself. Then we'll figure out who's who in the world of tax. After that, we'll get into the big difference between business and employment. Then we'll look at what actually counts as income, how the final bill is calculated, and we'll wrap up with a few crucial details that you really need to know.
You know, every law has this interpretation section right at the beginning. It's easy to skip, but you really shouldn't. Think of it less like a boring dictionary and more like the official rulebook for the entire game of tax. It makes sure everyone's playing by the same definitions.
Okay, so before we get into the rules, we have to know who's on the field, right? The Tax Act is super specific about defining all the key players involved.
Let's start with a big one. What is a person? Now, in everyday chat, a person is, well, a person, a human being. But in the tax code, it's a way bigger concept. A person can be an individual, sure, but it can also be a partnership, a company, a trust, even a whole government. So a company is defined as its own separate legal thing. It's an entity created by law, and the act is really clear that it is not the same as a partnership. And why does that even matter? Because treating a company as its own legal person is the entire basis for how corporate tax works. It's a huge deal. Now, a partnership is a different beast altogether. It's basically just a group of persons, remember that could be individuals or even companies, who've teamed up to do business together and make a profit. This structural difference is everything, because partnerships and companies get taxed in completely different ways. To make this next bit really clear, let's invent a character. Let's call her Alex. So Alex has been working a regular job for years, but now she's taking that big leap. She's starting her own business. And because of that, the way the law looks at her income is about to change a lot. The Act draws a really bright line between these two paths. Employment is pretty straightforward. It's when you have a position working for someone else, usually for a salary you can count on. Business, on the other hand, is this wide-open category for any trade or profession you do for yourself. This split is fundamental, because Alex has just jumped from the left column over to the right, and that changes everything about how her income is treated for tax.
All right, so Alex's new business is a hit. Fantastic. The money is starting to roll in. So now we need to figure out how the tax code actually defines and categorizes all this new cash flow.
The starting point for absolutely everything is gross income. This is the big top-line number. It's the total amount of money that Alex's new company brings in from every single source over the year, before she gets to subtract any of her costs. It's the whole pie. And that income can show up in all sorts of ways. Take the word royalty. You probably think of authors or musicians, right? But in the tax world, it's so much broader. The Act defines it as a payment for the right to use almost anything, from a patent on an invention, to a movie, to technical know-how, or even just renting out equipment.
So Alex's business has gross income. We've established that. But, and this is a really big but, that's not the amount she'll actually pay tax on. So let's walk through the steps to get to the number that truly matters.
It's actually a pretty logical path when you see it laid out like this. You start with that big number, the gross income. Then you get to subtract all your legitimate allowable expenses, and that gets you to your chargeable income. And finally, that number is used in an official assessment to figure out the actual tax you owe.
This right here is the magic number, chargeable income. It's what's left after you subtract all the legit costs of running your business from that big gross income figure. This is the amount your tax rate actually gets applied to. And that brings us to the finish line, the assessment. This is the formal, official step. It's when the Commissioner General essentially blows the final whistle, locking in your chargeable income and your final tax bill for the year. It's done.
Okay, we've covered the main players and the whole process from start to finish. Now, to round things out, let's zoom in on just a couple of other key definitions hiding in the fine print. These have some really big implications.
The law is really interested in knowing who is actually pulling the strings behind a company.
And that's where the beneficial owner comes in. It's not just a name on a piece of paper. It's the real, living, breathing person who ultimately owns or controls things, whether that's through holding shares, having financial power, or just being able to influence decisions.
And get this, the threshold for being considered a beneficial owner can be surprisingly low. Just holding 10%, only 10% of the shares or voting rights in a company might be enough for the law to see you as one. That's a really key number for transparency.
It's also really important to know that not every single organization pays income tax. The Act makes a special exception for exempt organizations. Think nonprofit charities, amateur sports clubs, or religious institutions, but they have to meet super strict rules. And the biggest one is that no single person can be privately profiting from them.
And we're going to end where the law itself begins this whole section. You see this phrase all the time, unless the context otherwise requires. What that's really saying is that while these definitions are our foundation, the specific situation, the context always matters. These terms are the building blocks, but you still have to look at the whole building.
So, what's the big takeaway here? Look, the language of the law is complex for a reason. It has to be precise, but it is not a secret code designed to confuse you. By understanding these key terms, you become empowered. You can navigate your business, your finances, and your responsibilities with so much more confidence.
So we've translated the jargon, we've decoded the rules. The only question left is, now that you speak a bit more of the language, what are you going to build with it? What does this new understanding make possible for you?